3 years ago, I sat in a restaurant watching myself order the most expensive thing on the menu. I don't mean I ordered it consciously. I mean I watched my hand point to the $38 sea bass as if someone else was controlling it. My friend had ordered the salmon at $32. My other friend went with the steak at $41. Somewhere in my subconscious, a calculation was happening. Not about what I wanted to eat, about what my order would say about me. I made $61,000 a year. After taxes, rent, my car payment, and the credit card minimums I was juggling, I had roughly $350 of discretionary money per month. This dinner was going to cost about $70 with drinks and tip. 20% of my entire month's breathing room, gone in 90 minutes. For Seabase, I didn't even like that much. On the drive home, I felt that familiar mix of pleasure and dread. The pleasure of having spent an evening that looked and felt successful. The dread of opening my banking app in the morning and seeing the number. I'd been doing some version of this for years. Spending to signal. Spending to belong. Spending to maintain an identity that existed entirely in other people's perception of me, while my actual financial life quietly deteriorated behind the performance. What I didn't realize at the time was that wealthy people, genuinely wealthy people, the ones with 7-figure net worths built on 5-figure and 6-figure salaries over decades, refused to do the thing I was doing. They refused to do it with such consistency that researchers have identified it as a defining behavioral pattern. They refused to do 9 other things too. 10 refusals. 10 no's that the average American says yes to every week without a second thought. These aren't dramatic sacrifices. They're not living in caves or eating canned beans by candlelight. They're small, quiet, nearly invisible acts of refusal that collectively produce an outcome so different from the average American's financial trajectory that the two groups might as well be living in different economies. This is that list. 10 things wealthy people flatly refuse to do that everyone else does on autopilot. Some of these will surprise you. A few will make you realize you've been doing them this morning. Let's get into it. They refuse to buy things to impress people they don't care about. This is the foundational refusal. The one that every other item on this list ultimately traces back to. Tom Corley spent 5 years studying the daily habits of 233 wealthy individuals and 128 lower-income people for his Rich Habits research. What he found was that the wealthy had almost completely severed the connection between spending and social validation. They bought things because the things served a function. Full stop. The purchase was evaluated on utility, durability, and value, never on what it would communicate to an observer. The Ramsey Solutions National Study of Millionaires confirmed this at scale. 94% of millionaires live below their means. 6 out of 10 live in homes worth less than $500,000. 61% of households earning over $250,000 a year drive Hondas, Toyotas, and Fords, according to Experian automotive data. The median price paid by millionaires for their most recent car was $31,367. These aren't people who can't afford the luxury version. They're people who looked at the luxury version, ran the math, and said no. Meanwhile, 8% of people earning less than $100,000 a year own a luxury model car, according to the same Experian data. People who can't afford it are buying the signal. People who can afford it are refusing to. I used to think this was deprivation. Now I understand it's liberation. When you disconnect spending from status, you free up an enormous amount of money and an even more enormous amount of mental energy. You stop scanning the room to see if your shoes are acceptable. You stop upgrading your apartment because your coworker moved to a nicer building. You stop leasing a car that eats 15% of your take-home pay because someone at a traffic light might glance at your badge and form an opinion about you for 3 seconds before the light changes. The wealthy person has already decided They don't care about the 3-second opinion. That decision saves them hundreds of thousands of dollars over a lifetime. They refuse to pay interest on depreciating assets. This is the refusal that separates wealth builders from wealth destroyers more cleanly than any other financial behavior. Wealthy people are not anti-debt across the board. Many of them carry mortgages. 90% of millionaires own their primary residence, and plenty used a mortgage to buy it. But the mortgage is on an appreciating asset. The house is expected to go up in value over time. The debt is attached to something that gains worth. What wealthy people refuse to do is attach debt to things that lose value. Cars, furniture, electronics, clothing on buy now, pay later plans. These are depreciating assets, items that are worth less tomorrow than they are today, and financing them means you're paying interest to own something that's shrinking in value while you make the payments. You're going backwards in two directions simultaneously. The average new car payment hit $767 a month at the end of 2025, according to Experian. 84-month loan terms are becoming normalized. A person who finances a $48,000 vehicle at 7% over 84 months pays roughly $58,752 total. The car is worth maybe $19,000 by the time they're done paying for it. They paid nearly $60,000 for a $19,000 asset. The math is brutal, and wealthy people refuse to participate in it. Total U.S. household debt crossed $18.8 trillion at the end of 2025, according to the New York Federal Reserve. Credit card balances alone hit $1.28 trillion. Auto loans reached $1.67 trillion. Nearly half of credit card holders carry revolving balances at 22.4% APR. Wealthy people look at these numbers the way a nutritionist looks at a deep-fried candy bar. They understand the mechanism. They see the destruction. They walk away. Not because they're smarter, because they've internalized a principle the average consumer hasn't. Every dollar of interest paid to a lender is a dollar subtracted from your future, and the compounding works against you just as powerfully as it works for you when you invest. They refuse to let lifestyle expand with income. This refusal is perhaps the hardest one because it goes against every cultural signal in America. When you get a raise, you're supposed to upgrade. Bigger apartment, better car, nicer restaurants, new wardrobe for the new title. The economy expects it. Your friends expect it. Your Instagram followers expect it. Your brain expects it because hedonic adaptation primes you to seek the next level of comfort within about 90 days of any new baseline. Wealthy people refuse. When their income goes up, their lifestyle stays approximately the same. Their savings rate goes up. Fidelity reported that the average total savings rate among 401k participants hit 14.2% in the fourth quarter of 2025, including employer matches. But that's an average. The people driving the number upward are the ones who increase their contribution every time their income increases. 45% of participants raised their contribution rate in 2024 alone. The ones who didn't are the ones whose lifestyle absorbed the raise before their retirement account ever saw it. The Ramsey Millionaire study found that only 31% of millionaires averaged a six-figure income over their careers. 1/3 never hit $100,000 in any single year. They got rich on moderate salaries because the moderate salary was enough. The gap between their income and their spending was wide, and they kept it wide year after year, decade after decade, while their neighbors' gaps closed with every raise and every promotion. My coworker Janelle got a $9,000 raise last year. Within 4 months, she had a new apartment that cost $350 more per month, a wardrobe refresh that totaled about $1,200, and a gym. Membership upgrade from $29 to $79. The raise disappeared. It was consumed by improvements that her brain registered as pleasurable for roughly 90 days and then filed as the new normal. Janelle's savings rate didn't change. Her lifestyle just got more expensive. Her manager, a woman named Carla, who earns $40,000 more than Janelle, lives in a 2-bedroom condo she bought 12 years ago and drives a 2019 Subaru Outback. Carla's investment portfolio crossed $800,000 last year. Nobody in the office knows because Carla doesn't talk about it. She doesn't perform her wealth. She builds it by refusing to let her spending chase her income. They refuse to make financial decisions based on emotion. This is the refusal that requires the most cognitive discipline because the entire American consumer economy is built on emotional triggers. Flash sales create urgency. Limited time offers create scarcity. Marketing campaigns create aspiration. Social media creates comparison. Every purchase prompt you encounter in a given day is designed to bypass your rational brain and activate the emotional one. Wealthy people have built systems that override this. They wait 24 hours before making any purchase over $50. They make major financial decisions on spreadsheets, not on feelings. They separate the emotional desire from the economic evaluation. They ask a question that most consumers never think to ask. If this item weren't on sale, would I still buy it at full price? If the answer is no, the sale isn't saving them money, it's costing them money they wouldn't have otherwise spent. Americans spent an average of $282 a month on impulse purchases in 2024, according to data from Capital One Shopping and Slick Deals. That's $3,381 a year on things they didn't plan to buy. Clothing was the top impulse category, followed by food, then household items. 80% of those purchases happened in physical stores where product placement, checkout aisle design, and end cap displays are scientifically engineered to trigger. Emotional buying. Wealthy people don't avoid stores. They avoid emotional states inside stores. They arrive with a list. They leave with only what's on the list. The list is the firewall between rational intention and emotional impulse. It sounds childishly simple. It saves thousands of dollars a year. This is not financial advice. But the next time you feel the urge to buy something you hadn't planned on buying 5 minutes earlier, pause. That feeling isn't desire, it's design. Someone engineered the display, the notification, the email, the sale price, specifically to make you feel that way in that moment. The wealthy person recognizes the engineering and walks away. The average consumer surrenders to it and calls it treating myself. They refuse to ignore where their money goes. 47% of Americans entered 2026 without any budget, according to YouGov data. Nearly 3/4 underestimate their subscription spending by more than $100 a month. The average American can't accurately account for roughly $800 to $1,000 of monthly spending when asked to estimate it on the spot. The money simply vanishes into a fog of taps, swipes, and auto renewals. Wealthy people don't let money move without observation. Many of them use systems as simple as a notebook. Others use spreadsheet reviews. Some use apps. The tool doesn't matter. What matters is the behavior, regularly, at least monthly, looking at exactly where every dollar went and asking whether each category of spending aligns with what they actually value. Tom Corley's Rich Habits research found that 88% of wealthy individuals saved at least 10 to 20% of their income. You cannot consistently save 10 to 20% if you don't know where the other 80 to 90% is going. Awareness is the prerequisite for wealth building. Without it, invisible spending categories, the delivery fees, the forgotten subscriptions, the impulse additions at checkout silently consume the gap between your income and your expenses until there's nothing left to invest. People who track spending save 15 to 20% more than people who don't, according to multiple behavioral finance studies. The act of tracking isn't exciting. It takes 10 minutes a week. But those 10 minutes produce more wealth over a lifetime than almost any other habit because they expose the leaks. Most people don't have an income problem, they have a visibility problem. Wealthy people refuse to let money move in the dark. They refuse to carry credit card balances. I've touched on this in other videos, but it deserves its own space here because the refusal is so absolute among the wealthy that it functions almost like a moral principle. 75% of millionaires have never carried a credit card balance in their lives, according to Stanley's research. Never. Not once. Not even when they were starting out. Not even when money was tight. They found another way. They cut spending elsewhere. They delayed the purchase. They used savings. They did whatever was necessary to avoid paying 22% interest on a purchase that was already depreciating. Total U.S. credit card debt is $1.28 trillion as of late 2025. The average balance is about $6,500 at 22.4% APR. Minimum payments on that balance stretch the payoff to 18 years and cost over $9,000 in interest. The total price tag becomes roughly $15,500 for $6,500 of purchases. Wealthy people see this math and experience something close to physical revulsion, not because they're judgmental, because they understand compounding. They understand that 22% working against you destroys wealth faster than 8% working for you can build it. The spread between those two rates is the distance between financial freedom and financial prison. Every dollar of credit card interest is a dollar that's fighting your investments. The wealthy refuse to fund both sides of the war. They pick a side. The side they pick is the one that compounds in their favor. They refuse to upgrade their phone every cycle. This might seem minor compared to car payments and housing costs, but the behavioral principle it reveals is significant. Wealthy people view technology as a tool, not a status marker. They replace tools when the tools stop functioning, not when a newer version is released. Only 23.5% of millionaires owned a vehicle from the current model year. The same pattern applies to personal electronics. A 3-year-old iPhone does everything a new iPhone does. The camera is marginally different. The processor is slightly slower in benchmarks that no human can perceive during normal use. The new model costs $800 to $1,200. On a financing plan, it's $35 to $65 a month in perpetuity because the cycle resets every 12 to 18 months. Over a decade, upgrading annually versus keeping a phone for 3 to 4 years costs between $5,000 and $9,000. That number alone builds a meaningful contribution to a Roth IRA or emergency fund. But the bigger cost is the mindset the cycle reinforces. Annual upgrading trains your brain to associate current with adequate and previous with insufficient. That association bleeds into every other consumer category. If last year's phone is insufficient, then last year's car might be too. And last year's apartment. And last year's wardrobe. The upgrade cycle isn't about the phone, it's about the psychological infrastructure that makes perpetual consumption feel normal. Wealthy people broke that infrastructure early. They decided that a functioning device is a good device. They use it until it doesn't function anymore. Then they replace it. The interval between replacements is years, not months. The money saved goes to work. The money spent on annual upgrades goes to Apple, which has an excellent compounding curve of its own. You just don't benefit from it unless you own the stock instead of the product. They refuse to spend their time passively. Tom Corley's 5-year study found that 67% of wealthy individuals watch less than an hour of television per day. Only 6% watch reality TV. Meanwhile, 77% of lower-income individuals in the same study spent more than an hour daily on television, streaming, and passive scrolling. 88% of wealthy people read for at least 30 minutes a day, primarily self-improvement, business, and financial education material. Warren Buffett has said he spends roughly 80% of his day reading, not emails, books, annual reports, industry analysis. The average American spends over 4 hours per day consuming media, according to eMarketer and similar data trackers. 4 hours. That's 28 hours a week. That's roughly 1,450 hours per year spent in passive consumption mode. What if 10% of that time, roughly 3 hours per week, was redirected to financial education? Over a year, that's 156 hours of learning about compound interest, tax-advantaged accounts, credit optimization, debt management, and investment fundamentals. Within 2 to 3 years, you'd have a deeper understanding of money than 90% of the American population. The wealthy don't guard their time because they're productivity robots. They guard it because they understand opportunity cost at the deepest level. An hour spent watching television costs the same as an hour spent learning something that could change your financial trajectory for the next 30 years. The hour is identical. The outcome is separated by decades of compounding difference. My own shift happened when I replaced 1 hour of nightly scrolling with reading about personal finance. Within 6 months, I'd increased my retirement contribution from 4% to 11%. I'd negotiated my car insurance for the first time. I'd opened a Roth IRA. I'd calculated my net worth. Each of those changes traced directly back to something I'd read during a former scrolling hour. The information changed my behavior. The behavior changed my net worth. The net worth changed my life. 1 hour a day. They refuse to surround themselves with people who normalize financial dysfunction. Corley's research found that 93% of self-made wealthy people credited their success in part to surrounding themselves with supportive, like-minded individuals. They actively curated relationships with people who shared their values around money, delayed gratification, and long-term thinking. His data showed that lower-income individuals spent an average of 6.5 hours per week in idle conversation and gossip versus 0.5 hours for the wealthy. This isn't about elitism, it's about behavioral contagion. Your spending habits, savings rate, and financial attitudes are measurably influenced by the 5 people you spend the most time with. If your friend group normalizes financing $45,000 cars, your brain starts treating that as baseline. If your friend group normalizes expensive dinners 3 times a week, your brain adjusts its expectation for what a normal week of dining looks like. If nobody in your circle talks about investing, investing feels like a fringe activity instead of a standard behavior. Wealthy people didn't all start out in wealthy circles. Many of them deliberately sought out financially disciplined people, sometimes through mentoring relationships, professional groups, or even online communities. They moved toward people who made building wealth feel normal and moved away from people who made consuming wealth feel normal. This migration is uncomfortable. It can feel isolating. It sometimes means saying no to friends you genuinely care about because their spending patterns are pulling you toward behaviors that contradict your financial goals. But the math doesn't care about comfort. The math says that if your social circle spends $2,000 a month more than necessary on lifestyle signaling and social spending, and you participate, that's $4,000 a year not invested. At 8% over 20 years, that's roughly $1.2 million of wealth your social life consumed. Your friend group isn't just your social life. It's a financial variable. The wealthy treat it like one. They refuse to make major financial decisions without understanding the full cost. This is the refusal that captures something most people don't even realize they're skipping. When the average American buys a car, they think about the monthly payment. When a wealthy person evaluates a car, they calculate the total interest paid over the loan, the opportunity cost of the down payment, the insurance premium differential between, models, the depreciation curve, the maintenance schedule, and the total cost of ownership over their expected holding period. When the average American rents an apartment, they compare the monthly rent to their budget. When a wealthy person evaluates housing, they calculate rent as a percentage of after-tax income, compare it to the cost of ownership, including property taxes, insurance, maintenance reserves, and opportunity cost of the down payment, and model both scenarios over a 10-year horizon. This isn't because wealthy people are calculators, it's because they've learned, often the hard way, that the sticker price of a financial decision is almost never the full price. The full price includes interest, opportunity cost, maintenance, insurance, depreciation, and the behavioral patterns the purchase triggers. A $3,000 couch financed at 0% for 24 months isn't $3,000. It's $3,000 of capital that isn't invested for 2 years, plus the psychological normalization of financing household goods, which leads to financing the next thing and the thing after that. Wealthy people slow down at the point of decision. They refuse to transact on autopilot. They ask, what does this actually cost me in total over time, including everything I won't be able to do with this money instead? That question, applied consistently to every purchase above a certain threshold, is the difference between a person whose money compounds for them and a person whose money compounds for someone else's quarterly earnings report. Here's what connects all 10 of these refusals. They aren't separate behaviors. They're expressions of a single underlying principle. Wealthy people understand how money works over time. They see every dollar in 2 currencies simultaneously, today's value and tomorrow's compounded value. A $7 coffee is $7 today and about $69 in 30 years at 8%. A $767 car payment is $767 today and roughly $7,600 in lost compounding per month of the loan. When you see money this way, every refusal on this list stops being a sacrifice and starts being obvious. You're not giving up the coffee, you're choosing $69 over $7. The math isn't even close. The average American doesn't see money this way because nobody taught them to. Financial literacy has never been systematically taught in American schools. The TIA Institute found that only 31% of Gen Z could answer basic financial literacy questions correctly. Among Gen X, the most financially literate generation, it was still only 52%. Roughly half the country cannot explain how compound interest works, cannot define APR in practical terms, cannot articulate the difference between an asset and a liability. These aren't advanced concepts. They're the fundamental rules of the game everyone is already playing. The wealthy learned these rules. Many of them learned them early, often from a parent, a mentor, a book, or a single conversation that changed how they saw every financial decision from that point forward. Thomas Stanley's millionaires weren't born frugal. They weren't genetically predisposed to driving Toyotas and packing lunches. They encountered a set of principles at some point in their lives, financial literacy in its purest form, and those principles restructured every habit, every refusal, every allocation of every dollar for the rest of their careers. That's what makes financial literacy different from financial information. Information is knowing that compound interest exists. Literacy is understanding it deeply enough that you refuse to pay 22% to a credit card company because you can feel the math working against you. Information is hearing that millionaires drive used cars. Literacy is understanding the opportunity cost so viscerally that a $48,000 car payment makes you physically uncomfortable. Every refusal on this list is an expression of financial literacy applied to a specific decision. The wealthy didn't arrive at these behaviors through willpower. They arrived at them through understanding. The understanding changed the behavior. The behavior changed the outcome. The outcome changed their life. The same understanding is available to you right now, today. The concepts aren't locked behind a paywall or a degree program. Compound interest, opportunity cost, the gap between income and spending, the true cost of debt, tax-advantaged accounts, the mathematics of time. Every one of these concepts can be learned in an afternoon and applied for the rest of your life. The people who learn them join the 5%. The people who don't keep doing the 10 things on this list and wondering why the number in their account never seems to grow. And here's the piece that makes the difference between learning these principles generically and applying them to your actual life. The specific financial traps you face aren't universal. They change based on where you are in life. The spending patterns that destroy wealth in your 20s are different from the ones that destroy it in your 40s. The mistakes that feel rational at 32 feel catastrophic at 58 when you see their compounded consequences. Each decade of your life carries its own version of the trap, its own set of decisions that feel normal in the moment and cost you enormously over time. The wealthy don't just understand money in the abstract. They understand which specific traps are designed for their current life stage, and they build systems to step around them. A 34-year-old who understands that lifestyle inflation is the primary wealth killer for their demographic can inoculate themselves against it before the raise arrives. A 52-year-old who understands catch-up contributions and Social Security timing can recover decades of undersaving in their final working years. Knowing what the traps are before they arrive is the difference between the 94% who live below their means and the majority who wonder where it all went. The refusals on this list aren't random acts of discipline. They're informed responses to a system designed to extract every dollar you earn before you have a chance to invest it. The system is real. The traps are real. The extraction is happening right now through your car payment, your subscriptions, your impulse purchases, your emotional spending, your passive evening hours, and the social circle that makes all of it feel normal. The refusals are also real, and they're available to anyone willing to see the game for what it is. See it, refuse, compound the difference. That's how ordinary people build extraordinary wealth. Not through one brilliant move, through 10 quiet refusals repeated every month for a very long time.